Good morning. Thanks for joining. Um, I will do a sort of a quick update and go through a number of things on the portfolio. I'm conscious that you will have just received our report, so um, I think I'll try and keep it short so that I can do questions, Q&A, so that we can cover the stuff you really want to hear about. Uh, the uh, we have done the data up to date for Friday because last week was material. So rather than do an end of June, we have brought it up to date. So here AUM is 1.6. The market cap now of Aurora is above 200 million, and the year to date return now is 5.6% as of Friday. The and that's where that puts the track record. I mean, you know what I think about that. Their short-term numbers are just noise. Through time, we would expect that you can see accumulating outperformance and alpha from our stock selections. And this is our, Aurora is joined our investment approach just from 2015 onwards. So this is the whole of that record, and here you see the power of compounding an edge over time, and this is for the UK fund. Its performance for the year is higher, 8.9%, only because it holds more Carson, has a bigger weight in Carson. The only activity that we've done in the half was we did a trimming of Ryanair right at the beginning of the half. It was just 1%, but it was because of the Boeing. We spent a lot of time trying to think about what happens if Boeing not implodes, but the Maxes are grounded or they have to go back to square one, and what does that do? And there's balancing factors as far as Ryanair is concerned, and you've got a very, very capable management team that will exploit crisis for opportunity, and we're comfortable now where Ryanair was. But at that point in time, on the sort of balance of probabilities, it was a piece of news you didn't want, and the potential outcomes were skewed towards the negative. We added to Lloyd's. There was a pullback in Lloyd's on a reaction to the car loan liability, and a bit of an overreaction, really, considering how small that book was. And so we picked up some Lloyd's at that point. And Hargreaves, we'd started to buy it just after it left the FTSE in December, close to £7, and then it had a run up, and then back in March, we were able to come back in and build up a 2% position, and then it's obviously been bid for. This is how the portfolio looks now after the move in Carson. So it pushes Carson to being the second biggest holding after Fraser's. But otherwise the portfolio doesn't look very different to what you've seen before. That move in Carson does push it in the money, and so it's only EasyJet now that's trading below what we paid for it, and I think that will ultimately be a holding that when we close it, we will have lost money on. This is how the weights have changed in any year. Not a lot. We're masters of doing nothing, so the movements tend to come down to the share prices. And here it is in share price terms and NAV terms, also reflecting that move. And the NAV will have moved another 2.5% on Friday, as well as Thursday. The discount has narrowed a bit. I mean, I wouldn't put too much store on what's just happened the last couple of days. We won't be able to tell until that settles. We have paid some attention to that discount. We recognise that we're in a sector and of investment trust where discounts are an issue. We don't want a persistent discount, and we're doing things trying to mitigate that. And then in terms of upside to intrinsic, even though we've had that performance when we update all the intrinsic values, which we publish once a quarter, the overall intrinsic value is 130% above where the NAV is. And ultimately, intrinsic value is our sort of our guiding light to where to expect returns to go. So if I go forward and show you this chart, ultimately intrinsic value leads the way. It's the measure of the stored up value in the portfolio. This is for the Phoenix UK fund, which now has jumped to 9,500. But ultimately, we care about the future, not the past. That's why you own it. The best guide to what the future looks like is the amount of upside to intrinsic value. I'll stop the slides, but I did want to say a few words about the portfolio. If you've read the report, we put something out about position sizing. So the reason why Hargreaves was a 2% holding and not a 10 or 15 was the amount of expertise. That's been in our candidate universe since 2018. We've done a lot of work, but we don't have the expertise you have from being in an industry and running a monitoring program, the likes we do have with Frasers or the house builders. And so that weight reflects that potential probability of a mistake rather than the amount of upside. I talked in the report about this pendulum shift, and that's genuine. I sort of felt something in my gut, and we're certainly not gut instinct investors. So I try to work backwards from what is it, and what was driving that, and what were real factors and what were not, and I put those down. I mean, the thing about a pendulum swinging is ultimately that switchover point is when the force is pushing it in that direction diminished to the point where they're overtaken by the forces pulling it back. And those long-term forces of having all the pension schemes divest their UK equities, that's pretty much run its course. The negative impact the governments have been having on the UK economy and the market, or that those have been diminishing, and then the effects of Brexit, both the paralysis beforehand, the waiting for the actual negotiated deal, and then the negative impact of the execution on trade. That's all pretty much done. And then on the other side, even under Rishi, the government has started to unstitch some of the worst parts of the hard Brexit, some sensible solutions, pragmatic solutions, working with Europe, and now that's going to be turbocharged by a Labour government that doesn't have the baggage that the Conservatives had. The cheapness in the market is triggering a lot of M&A. And it's not just as M&A; it's the nature of it and the nature of the premiums that I think highlight the undervaluation. And then buybacks. I spent 25 years trying to persuade UK managements to do buybacks, and have heard various versions of, it's an unimaginative use of capital. We have investors who want dividends, and all of this, and all the merit-based cases that we've made for buybacks have generally fallen on deaf ears. And even if management bought into them, boards didn't. That's definitely changed. And when you get buybacks, when equities are so cheap, it's enormously value creating. We've also had incoming inquiries from overseas investors about the UK, and we haven't really had that for about 10 years. And that really has sort of picked up this year. And it's smart investors, it's shrewd investors, of people who are driven by value. So that makes me think something's changing, but we're not forecasters, and we wouldn't want to be rewarded based upon our ability to forecast macro events. what matters is the portfolio and what we own, and there's some things in there that are quite material. So house building is our biggest concentration of exposure, but with our Barratt and Bellway holdings, and Barratt's merging with Redrow to create the biggest and most diverse UK house builder. Labour wants more housing. It's a big part of their policy. Obviously, we're going to probably learn a bit more today about how that's going to manifest itself. This will be our 26th housing minister, and quite often we've seen words not translate into deeds. But new governments do tend to get on and do things. But we've had the bad. When the Conservatives first came in, they tore up all of the targets, and initially that was just a green light to all of those local authorities who didn't want to do planning. And there was a real hiatus, and then that's soon replaced. So whatever we get in the short run in policy, we know if the intent is more house building, and then you need the house builders. And so that's a great backdrop for us in what has been a hostile government towards the house builders in the last 5 years since Gove got involved. A lot of our portfolios are having buybacks. We expect once Barratt's on the other side of the merger with Redrow, because of the strength of its balance sheet and the excess cash it will have, and the strength of the land bank, it's going to be buying back shares. And again, with the equity so cheap, there'll be a lot of value creation there. Lloyd's is doing it in a material way. Again, the same thing. We don't mind them staying cheap if the cheapness is being used to buy back shares. Then the shares can go up and they can stay cheap, and more and more. I mean, just to sort of make the point, if Lloyd's is on about 5 times its earnings and it used all its earnings to buy back its shares would go up 25%, even if it just stayed on 5 times. Now, that's not what they're doing, but it shows the materiality of upward, value creation from buybacks. Travel, as miserable as the weather is in the UK at the moment, the more that is good for people traveling. Now, we don't make short-term tactical investments like that, but it ought to be good for EasyJet and Ryanair. What's more material is the constraint in supply of planes. So the airline industry has a cyclicality to it, a capital cycle. In good times, too many planes are bought, and then ultimately, when those planes arrive, returns diminish, and shareholders suffer. Even if there was a propensity to buy too many planes, that's not happening. But Boeing's got its issues, and that's constraining its supply, and Airbus has its own supply chain issues, and so it's restricting the supply. And that shortage of planes with rising demand for travel will translate into higher prices or fuller planes, and that's a nice tailwind for our airlines. And the other thing, sort of Frasers, it's sort of emerging now. You can see it more clearly. Frasers has added another leg to their business in the credit side. Frasers Plus, it's in their business, and then they're adding it to other third parties. It'll be coming at Hornby, I think, this month. And in there, they've created another strand of value to the business, which again is not really appreciated in the valuation at the moment. So all set. I think we have a portfolio we like. They have a tailwind. We may have a macro backdrop that is positive. I don't know whether interest rates are going down or up or not, but we can tell from our data that the activity in the housing market has already turned and is improving. It's sort of, they've digested the higher rates and now we're at the other side. So should we get lower rates, well, then there'll be even more of a tailwind. And then as far as the UK market's concerned, it looks like it's attracting more attention. That might be great for values. It makes it harder for us to find things, but at the moment there's a lot of things that look attractive, or that we're not far off on. So Um, I should talk a little bit about Carcinoma. That value creation at Dignity really is just a first step, and it really does relate to the balance sheet. If you think in enterprise value terms, when we approached the business with the bid, the debt was 540, and we paid close to 300 all in with fees for the equity. So nearly 850 enterprise value, and the equity now is valued at 500, but we're talking about net debt from the repayment we're about to make to be 400 at the end of this year. So you're talking about 900 of EV. So although it's quite material in equity terms, it's not overall for the business. We haven't marked up the future yet, but underlying trading has improved, even though the death rate's down, and valuation model can't ignore that, the current year numbers. The biggest thing from our perspective, if you're in the office here and you're in the boardroom, then you'll see it on the wall. We have our investment principles, and one of those is avoid leverage. And so this is the delevering of Dignity is quite important. It takes the risk of bondholders ever having a say in the outcome of the business away. And with that level of debt repayment, the business comes sort of performing above covenant, which makes quite a material difference to how it operates. So that's good, but it really is early days on executing the plan that will deliver the rest. I mean, we're talking about, it's still only a third of what we think it's really worth in valuation terms. So on that note, I'll hand over for Q&A.
Brilliant. Thank you very much, Gary. Just a reminder, everyone, please use the Q&A button at the bottom of your screen to submit questions. We'll go to the first question. What, if any, read across does the difficult trading at Nike have for Frasers? And what are your views on their growth trajectory from here, given the position size in Aurora?
There's a lot of strands to that. I mean, Nike, if it's having difficulties, which obviously it is, it's from a very high point. It's had a terrific run, and business just doesn't unfold in straight lines. And the problems Nike have are what happens when is what comes from success. Hubris breeds things that can lead to this kind of setback, but also overexposure can lead to that. And what will happen is Nike will figure out what went wrong and fix it, and they'll sort their issue. As far as Fraser is concerned, the relationship with Nike just fundamentally changed. So the materiality of what's going on for Nike doesn't really read across to Frasers. What's much more important for Frasers is that Nike lets them have a product that they currently don't have, and increasingly that's what's going on. That's what we're picking up in our monitoring. So that's more important. Having your biggest supplier be slightly weakened, in traditional sort of retail dynamics, power dynamics, having that to the benefit of your other suppliers, potentially positive. But Nike is so enormous and so important that really won't change the dynamic. Frasers will sell whatever customers want. So if Nike's not selling, it's because someone else is selling. Then as far as Frasers is concerned, they're brand agnostic. So they'll work with anybody who's got products that customers want. So I don't think it changes their underlying growth trajectory. The overall market isn't shrinking. That's not what Nike's saying. It's saying that they've lost share. Yeah, that's what I would say.
Thank you. You mentioned Hargreaves Lansdown takeover. How concerned are you about the shrinkage of the UK stock market due to lack of quality IPOs and high level of price to equity ratios and overseas takeovers?
I mean, it's not a good thing. we try not to sort of impose a view of the world on things, because you only tend to get frustrated and disappointed. So our job is to navigate whatever's going to come, and we're not constrained to having to own UK listed companies. We want to understand the company. So, but if there's a company here and it's a UK company that decide to list in New York, well, if it's cheap, we'll buy it in New York. We don't have to buy it in the UK. I think it's the same pendulum effect that you'll get. The UK now knows it has a problem. The stock exchange and various other people know they have a problem, and that's the most important starting point, because there's a will right now to fix that, and you see the efforts are being made to change that, and so I'd imagine it will change, but it takes a while. We're not worried about lack of IPOs in the short term, because we don't buy IPOs. People don't tend to float at bargain prices, but IPOs do tend to turn into bargains, sometimes quite quickly. So yeah, we would like to have more of them. But I just, the things that we see happening, the efforts that are going on, and this government as well, would suggest that the UK will make itself an increasingly desirable place to invest, and it's not as disastrous as it looks. It's still a large market, and yeah, like I said, I feel like the pendulum's shifted, and if we get underlying performance in UK equities and we get better valuation, well, then it'll feed upon itself, and you'll get more IPOs.
We've just got a couple on Dignity. So as far as you're allowed to comment, could you, in a little more detail, sort of reference how you are valuing Dignity and the maths behind the recent write-up in equity value from the £100 million trust withdrawal? And also, you, I think in the quarterly report, mentioned the possibility of repaying a further 50 million of debt. How would this be funded?
Right. I'm always aware that a bond investor will ask, and that's just to understand the constraint here is it's not the equity of Dignity. It's now a private company, and I'm very conscious of where we are in Casino terms. We can say it's the fact that the bonds trade, and we have agreements with bondholders. So we formally certified what our position is to bondholders, and it's in the public domain. Last Thursday. That's what we were waiting for, the announcement, and we also certified that we are still working on the rest of the restructuring. So just let me come back to the origins of the question. So valuation, it's a process. So someone, not me, does a valuation model that is then exposed to a third party company, Kroll, and that model goes through, and ultimately goes to the auditor and the board, and they're constrained by the way that world works. I try not to opine on. I mean, we're used to taking share prices as they are, and to be honest, that's what the valuation in some ways is doing. Is if this was a share, where would it trade? Or what's the current valuation? So we have to take down valuations when we have a bad trading period, because that's what stock prices tend to do. Yet intrinsic value may not have gone down for anyone looking far enough forward, but auditors always say you can't evidence the future, and so I tend to be very arm's length from that that stuff. What's happened here is yes, nothing in the model for the surplus that sits in the trust. And the surplus that sits in the trust is over 300 million. So the release from the trust, which is taxable, but is effectively new value for the equity and debt, because it's going to be used to pay down the debt. And that, with the other resources that are in the company, mean that overall by the end of the year, 100 million of debt will be repaid. Well, that's £2 a share. So that's that. It's the surplus in the trust still set above the 1 in 200, and still highly material, and high 120s of solvency. So it isn't that we've robbed Peter to pay Paul. It is extra surplus, because essentially the trusts are invested in equities, global equities, and their liabilities are in long-term interest rates. So the repaying of the debt lowers that, and then the actual trading, actual EBITDA versus model is better, and so that's a reality that has to be reflected in the model. What isn't in the model is whether or not the rest of the debt could be paid at a discount. So there's 400 million when we repay that debt of securitization left, but that deal with the bondholders allows us to repay, providing we do it by December, at approximately 350 million, and that would be another 50 million of value, £1 a share, and that is what we're working on. And I don't want to comment on how that would happen, but that is another piece of uplift. The growth in funeral plans, executing that strategy in funerals, so we're growing share and increasing profitability, growing profitability and memorial revenue. All of these things are in the strategy for the business in crematoria. None of that's in the model. That as that gets executed and there's evidence for it, I imagine it will go into the valuation. Nothing that's happened has changed our intrinsic value. So this is just a revelation of things that we already knew.
Brilliant. Thank you so much. Without mentioning names, can you comment on how many positions are in the portfolio but below the reporting 3% level? And added onto that, what's your pipeline for new potential holdings?
Let me. Apologies, I'm having to sort of manually count them. I make it 7. Hargreaves is actually down there now as well because it's now 2.8%. It was 3% at the month end, but that latest move has made it. Yeah, the pipeline is good. There are a lot of things that are. There's a difference between things that we would like to own. Are they at the level where we could buy them? We would have been buying them if that was the case, and we haven't bought anything since Hargreaves. Things that are we're working on that if we verify what we call that they're double A's, so they're an A for business and A for management, that we would be able to buy. There are even more of those. So that's it. I mean, that's where we are. We wouldn't have. I mean, we're going to end up with, after the Hargreaves, close to 6% cash, in a cheap market. Someone's going to say to me, "Why don't you just buy second best?" No, it's all got to line up, and then we'll pull the trigger. And if it's in a space we already know, then we can put in more than 3. But if it's something new, then it will be a 2 or 3% type of investment. And then there are levels where we would add to existing holdings if they have pullback, like we did when Lloyd's came back to 37, 38, and we added to that, and that's not possible now. It's in 55 or something, but cash will get deployed. The ability to allow the cash to build gives you that ability to act when the opportunity comes along. So, yeah, I mean that's it.
I suppose it's a bit of a double-edged sword in terms of, we're all hoping for a UK market bounce, but in terms of your very strict, disciplined entry price at 50%, you probably don't want to see too many get away from your target price where you can actually enter.
I mean, I've got to be careful not to be flippant in the public domain. Obviously, we need performance so people can see that we're doing a decent job, and we have very, very patient investors, but their patience not forever. But actually doesn't get me excited an up market like a good war or a crisis or something like that. So that's when we really add value, when the dislocation. Now you can get a dislocation in an individual stock. You can look at what's happened to the share price of Burberry. The UK might have been bouncing and stuff, but Burberry's doing incredibly badly. So individual companies and sectors can have problems, and those are our hunting grounds. And ultimately, to get the sort of price that we want, that something needs to be going wrong. and those do happen all the time in business. So the prepared and patient mind gets rewarded. We have the 28 years of history. At times, cash has built 20% or so, but more often we get ourselves to fully invested. So my expectation is the cash will get deployed. We're not bereft of ideas. We could just do a bit of turbulence would be welcome.
So actually, you say you're masters of doing nothing, but obviously, how's your approach to analyzing your companies and their risks developed over the last few years with interest rates, politics, war, and company-specific issues? We've certainly had no shortage of turmoil.
No, I mean, that's what we do all the time. So we actually are very busy, just not busy pulling the trigger on a trade. We spend a whole time trying to figure out what's going on in the world and what's going to go on in the world. I mean, we are investors are being asked to be clairvoyants all the time, and that's an incredibly tough puzzle. So we're always trying to figure out what's happening in the world. We're less concerned about mean reverting noise, cyclicality. We're more interested in what's happening if young people are not drinking alcohol. What does that mean? Is that a shrinking market? That we'll spend a lot of time trying to figure that out. Can we figure out what's going to happen in the future to Diageo because we figured out what's happening to the consumer trends in consumption for alcohol, and it's the same for our businesses. So we spent a long time thinking about Boeing, and what worried us was that Boeing's problems were cultural, and cultural problems aren't easy to fix. And so we spent a long time scenariozing what happens, and that's what we do. Interest rates and stuff, not really. I mean, we test downside stresses, but we avoid businesses that have those problems. Lloyd's will be worth different things a little bit depending on what the interest rates are, but not really. We ask ourselves why people aren't switching to other banks, or why the persistence of bank franchises is as it is. And that's what we're doing all the time on all the holdings. Looking for new things is a fraction of our time. We mainly spend the time on our existing businesses. The analysts working on monitoring programs, and we're interpreting that data and trying to figure out what is the world unfolding in the way we thought, and if not, do we need to are we right to be invested in something? And I would say COVID was complicated because you didn't really have one before. All the stuff that's going on at the moment is obviously it's got its usual complexities, but it's not as taxing as COVID was for business models. Whoever's in the White House or even across the channel, won't have a material effect on people's propensity to want to own a home or buy clothing or travel. We don't think.
House builders are still a large weighting and clearly a key area for the fund. What are your views on the future for the sector and your holdings? And do you have any views on the brick makers in this environment?
So we like the demographic backstory. The people who need houses are already here. We don't have to be very clairvoyant to figure out what the demand is. It's there, very, very clear. All of the things that are being contemplated to improve demand, we look at whether or not they will be paid by landowners or shareholders, very broadly. You change an environmental regulation, well, that will be in the land price, providing it applies to everybody. So when we look at all of the things that are happening, they look very positive for shareholders. We've had a CMA investigate the industry in real detail, asked to do by a hostile minister, intent upon finding something to beat them up with. And then you've got the CMA saying, yes, they do make high returns on capital. Their shares trade cheaply. Their cost of capital is high, but they still make an even higher return. However, if you constrain that, you'll get less houses. And the consumer harm is less houses, so you need more houses. So you need the house builders. So we got the position set very nicely for them. There's something going on in house building that's interesting. These mergers, what's the benefits to scale becoming clearer and clearer. And most people don't get this. Why have we not had a new house builder since 1974? Why is it so hard? Why does Elliott have to reverse theirs into Crest and stuff? Why don't they just buy the land and build it up? And that is so that the barrier from scale and the benefit from operating multiple brands that Barratt and Persimmon and others are going to have from what's going on. That really favors the large house builders, and if we're going to have volume output, the solutions are likely to favor the large house builders. So I feel very positive about that, especially from the starting point. So cheap, got cash, have land, people want houses. So it's hard to see how that won't result in good outcomes for house builders. I've given up thinking about whether they'll ever be re-rated. If they buy back shares, then I hope they'll never re-rated. But no, I think it's well set. I think that's is what I'd say about house building.
Thank you. So on a more general point, so the assessment of management is key to your three-prong investment approach: business, management, and price. And talking of buybacks and some other company, let's say, idiosyncratic issues that have happened over the last few years, what is your view on general company management capital allocation in the UK market, with its traditional focus on dividends compared to the US, for example?
It's been a real frustration. I started as a very naive person going out on the road to meet managements, and then having read all my Buffett and everything else and asked questions, I wasn't even speaking the same language. I didn't know what capital allocation was. Now everybody's got a framework, but a lot of them are intellectually incoherent. They're a framework because it needs to be in the annual report, and people have asked them. But to understand where it makes sense, and the answers are out there. So the Simon Wolfson of this world are just very, very rare beasts, which are not in the US. So it has been a frustration. We sort of resigned ourselves to it, but the income funds are real, and I've been sat in a room with 9 other of the top 10 investors of a business I won't mention, and heard the ask for dividends. Even though the value could be created by buying back shares and the capital gain would have been greater, and even so it's real. That's why I've almost been caught out by how much it's changed of late. So it's no longer feels like a hard conversation, beginning to push on an open door. I think even the income funds have realized. Now, they don't say no dividend. We're not quite at that level. We're still like, well, dividend and buybacks. And then I think as managements do it and see what it does, and we're getting positive share price responses. You don't get this is an unimaginative use of capital, which is what someone would have written 10 years ago. Have they got nothing better to do with their money? You're now seeing it. It's still not as smart and joined up as we'd like it. We still don't have the sort of the people who would feature in William Thorndike's Outliers. You don't have we don't have that type of thinking about people buying back, but some, and you get the Mike Ashleys of this world who just got it from the beginning, who are constantly, mental value people who can see the value of buying back a lot of their stock. So it seems to have caught on. People will see the effect of it, and I think that's really, really material. But we've got managements who don't get it. And we'll try to have very few of those in the portfolio, and we will benefit a lot from having people who do get it. Even Barratt started buying back stock. They stopped for the merger, but our strong expectations is that they will resume that on the other side of the merger with Redra.
Just on the buyback, I suppose in stocks where there is low liquidity, with a backdrop of wealth management industry consolidation, there is a relatively smaller pool of potential buyers. So how do you balance your position and the short versus long-term considerations when buybacks just further shrink potential free floats?
I think the liquidity question tends to be monetary. People don't say, oh, that one trades 1 million shares and that one trades 100,000. They care about the combination of that and the price. So you have a 100 million market cap company that buys back a fifth of its shares. If that's out of excess profits, then its market cap will still be 100 million. Its price will have gone up 25%. The share count's reduced, but the price will have gone up, and so you've still got 100 million pound stock. So it shouldn't be material for liquidity. I'm sure there are individual outliers of free float issues that you get, but actually liquidity tends to go to value, not share count, I think.
Where and how do you see further growth in Castlenow Group? Where are the other companies in Castlenow on their own valuation creation timeline?
Yeah, they're all in different places. I'm going to do a very quick run through the portfolio. Hornby, we have to mark to the share price. So when Mike Ashley was announced as an advisor, the shares doubled, and then whatever that it cooled off. No following announcement. It's gone back to where they were before. Mike was for a short term pleased. He thought he was worth £5 million of extra value or something. We're at a stage with Hornby where this is a delivery point for us. So this is an inflection point of where profitability needs to emerge with individual strategies for all those individual brands. So we're still quite strongly engaged with Hornby and expect to be, and the help from Frasers will be well received. One of the issues that Hornby has is it sources in Asia and has way too much inventory, and that is something that Frasers are masters of, and then developing individual brand strategies. Now Ollie's in place, and he's settled as a CEO. We want to build those. The company needs to take costs out, get inventory down. That's because it's a public company. I mean, if I'm tiptoeing, it's because I don't want to say anything price sensitive. But nothing exciting is happening tomorrow. But that's early days in the Hornby strategy. Cambium, the first business in Castlenow, the wedding business. We have a lot of business across the portfolio where it's been hard to figure out what COVID did. So you have a boom of Netflix subscriptions, and then you get it's dropped. Is it really dropped? Are we peak Netflix, or is it just when people have been let out, then there's no new subscription? So and what happens in most of them, the data catches up and you can figure it out. We still have in furniture, we have in AO, we still have the overhang, we still have the overhang in Wayfair and stuff. You can see that people overbought during downturn, and it's still suppressing the market. It's very tough to know what happened in weddings. In deaths, we get weekly data. We know where we are exactly with deaths, but we're having now a catch up. We're now getting a lower death rate to be expected because we can't do a funeral twice. So in marriages, the data is so delayed from ONS, and only in June did they publish 2021 and 2022. So the wedding business came into this year expecting that the effect, we had no weddings, then a lot of weddings, and then expect that to come off, but maybe normalization. But the only thing that really probably explains what's happened this year, so a business down 10 to 12%, is that there's less weddings, but we can't verify that, but we know from venues that they're acquired. So there seems to have been an effect of less engagements that would have fed into weddings. We do know we've got strong growth in the pipeline for next year because we have registrations for future weddings, and so we have a 12% bounce back at the moment. But that's affected the business. That's a further round, and so what they've done is a further round of rationalization to have the business be profitable, and but the valuation reflects that recent trading. But actually, the business, one of the measures I use is how much revenue we've taken versus per wedding, and up to 2022, that was continuing to grow every year. There's no sign that a competitor's emerged. So looks like the number one business in the space. We just don't fully know whether we lost share. There's no other evidence that we have. The Stanley Gibbons business, we put through an administration really an inevitable because it hadn't been able to shed the liabilities of the past. So it's been through the administration. It's been rebased, and they're building that strategy very thoughtfully, piece by piece. And so, from a valuation perspective, they can only evidence what business plans there are, and we don't want to drive that quicker just to create a valuation. So that's been quite heavily written down, which is appropriate because we're just rebuilding what that strategy is. But it'll be the same, a stamp and coin a business that will then add on other verticals centered around excellence in serving collectors, but also building new collectors of the future. So that's Stanley Gibbons. The other companies are enabling companies. One's our AI data science company. You can see they keep signing up new customers. That's a different space. We're going through a funding round now in that sort of VC world. That's about to close. They continue to accelerate their ARA. That's the way that world talks. And then we have RawNet, which is our enabling digital agency. And the way we took that business in thinking that we could have that as the arm, the digital agency for the group. And we now think more in terms of that is a business best owned by its employees. So we're actually working on a structure to allow the employees to buy back some of that equity, and because that world is a fast changing world. And it's not our specialization. We wanted them as enabling. It's not we have a vision in digital agencies. So, so that's where they all are. They have some material upsides on successful execution of those strategies. Hornby probably by far the biggest in terms of materiality. And then we may add other businesses. I mean, if we get to the stage where we feel we have the bandwidth, but we're not there. We've still got, but we have a couple of other fields that we're looking at, and so in the future, value creation will come from if we think we've figured out how to do this, then applying it to another business.
Just on that bandwidth comment, how's the strength and depth of your team developed then, with Carson Group expanding and also some other holdings coming in?
Yeah, when we're now. I said I never wanted to be so big that I didn't know everybody's name and stuff like that. So we can't go much further. My memory deteriorates as I get older. So I think the organization is 28 people. So we're fully staffed. There's a separate Carson team that looks after Carson. So we have Rich Brown came on as the CEO. Carson team run all the improvement work within Carson, so they've got the bandwidth for that. And then the investment team, which is 12 of us. We almost have one person per holding, so I think we have that bandwidth. What I meant in terms of we need to focus on making sure our businesses in Carson are working before we turn our attention to anything new, and so that's what this year's about, is having an exit where they're all in a profitable shape and on the right trajectories with the right teams in place. Then we can lift our heads up and think about what next.
Just a question on the airlines. So is there a potential risk for the airline holdings from the lawsuit against BA and EasyJet for flight delays? And given airlines are actually quite a newish sector, given that I think 2016 was the beginning of the first holding, what have you experienced from investing in the sector? And how was that a particular type of impact from a single issue? Have you ever experienced that before in any other sectors you've invested in?
Yeah, no, we've run into some horrific idiosyncratic situations. So we were in online gaming when the US decided to ban it, although not ban it as it turned out. It just said what's illegal is illegal. So yes, at the airline industry, it very much suits us. I think because it is tough to figure out what's really happening. it is prone to things that ultimately end up being noise. Yes, cyclicality, but the fuel prices, these things are idiosyncratic to airlines, but the underlying reason why people travel is quite interesting and persistent. And COVID was a nice stress test of that, and even environmental worries are another stress test of that, of how important it is for people to travel. And the two businesses we have identifiable moats. And they've been proven. So we've seen Wizz try to build a business at Gatwick to tackle EasyJet, and you can go there and spot the Wizz plane. Send me a picture. The idea that EasyJet's strength comes from owning positions in slot constrained airports and then being the low cost producer in those airports. That's where their pricing power comes from. That's been borne out by everything that's happened. Ryanair is the low-cost operator, bar none. And again, that's been borne out. They show me a battle head-to-head between Ryanair and Wizz that Wizz have won. And so we have two businesses with moats. The stuff around that, taxes, fine, all of these various things, if they apply to the whole sector, we're okay. Again, they tend to be noise. Boeing different. If there's only two airline suppliers and Ryanair relies upon just using one, and so does EasyJet on one, and that means if there's a problem with that, you could have a serious issue, and so we worried about that. And if the Boeing planes prove to be dangerous and grounded, well, then that can't be good for Ryanair that uses them. So that's but when we think through the implications and how that would work and how Ryanair would respond, you start with a very strong balance sheet and think how they'd navigate it and their opportunists, and we take some comfort. But we watch that situation very, very, very closely. So no, airlines is of interest to us. Where we made a mistake of enormous proportions was management, and we backed a really good management at EasyJet, and Karen McCall and Andrew Finley and the CFO, they were using capital allocation methodology that made them focus their efforts where they had high return routes, and that just translated into shareholder returns. So they replaced a flag planter with a capital allocator, and we had wonderful returns. And then Carolyn left and went to ITV, Andrew left, and then we went into COVID with a management team that we didn't rate for capital allocation. And we had one small rights issue, which was within the things, and we were okay with that, and the balance sheet was strong. And then when they didn't need to do it, just as they were coming out, they did an enormous one when Mr. Hester joined the board. And it was very damaging. And also when we sat in front of them, they couldn't even do the basic arithmetic of the damage that they'd been done. And we'd taken our investors' money and given it to people who didn't know how to allocate it, and made an enormous mistake. That could have happened in any industry. That's not because it's airlines. That's because of us. And we've learned a lesson from that.
Thank you. Just on the house builders, is there any way that a government's forced pace of house construction could be considered a negative?
These things, you sort of have to think through what would happen if you gave a permission and said, okay, we're signing off 1,000 houses, and if you only build 50 a year, that's 20 years. So we're only going to give you the planning permission if you can sell, if you build 100 a year. And so the house builder would have to say, well, I may have to discount to sell those, and I'll put that number into my price, and therefore the land's worth less. And if the same rules apply to everybody, well, then the land is worth less. Now, it doesn't help with your existing land bank. So you want somebody who's got a short land bank that isn't full of these great big strategic, and that Barratt is the shortest of those. But imposing that backward is quite hard to do anyway, and people have already got the permission, so it's likely to be going forward. But when you explore those, they just don't quite work. There's no free lunch here. You say, well, I want you to build them, knowing that you won't be able to sell them, so you'll have to discount them to clear them. Well, if you impose that on someone, in a voluntary market, well, what they'll do is discount that in the price. And if you put it too heavily, the land will be worthless. There won't be a transaction. The house won't get built. So it ought not to. But what's interesting is if you have multiple brands, you can build a site quicker. And that's what's happened. Barratt's found that they put a David Wilson and a Barratt on a site. They can sell it twice fast. Now, if they add Redrow, they've got 3 different types of products. There's only so much demographic demand in a community, but bring multiple brands, you can do that. And this is really what would probably happen, is that house builders would sell slices off to other house builders in order to accelerate, but not for the same demographic demand. So most of those things, when you think them through, they're not harmful. But that doesn't mean politicians can't come up with something that's harmful, and we've got to expect that will happen, especially with the new government. What I would say is that those things sort themselves out. Ultimately, what happens is like Yes Minister. It's the civil servants who prevail. Sorry.
No, too true. In terms of Aurora Investment Trust, are you restricted in your ability to add to any holdings, given the size? But if their upside to intrinsic value is still very attractive, do you find yourself curtailed at all?
The investment trusts work for our investment style, which is we like to run winners, and most regulated investment funds don't suit that. They force you to sell your winners, and you can add infinitum to your losers, and that we think that's a really bad thing. But they do have some limits. So one of them is 15%. So 15% of cost. So if a holding is already above 15%, then we can't add to it. We have our own rules that are like that anyway, cost price limits, and 15 is our number for a single holding, 20 for a sector. So that isn't an issue for us. But if it's below 15, there's nothing that prevents us from adding to it.
And just the final question. I mean, since 1998, when the strategy started, you're in Barnes and you try to look at the market and perceived risk versus reality from a different lens. With all this technology advancement, is the gap between perceived risk and reality shrunk or actually grown, given the sort of obsession with lots of data points, more noise in the market? Are you finding it more attractive or less attractive?
I mean, there's a lot of information available. So there's never been more need for sort of clear thinking. It's change that tends to cause problems. I mean, and we do think some of the AI implications could come really quite fast once the penny drops, faster than ecom did, because it's down to adoption. So either people or managements. So ecom needed human adoption. I mean, there's still only a small minority of people order their food online. They still tend to go to a shop. That's 20 years in. That's up to humans, no matter what management wants. But if this was about tools that could make your warehouse more productive or your office more productive, that is in the gift of management. That could happen quite quickly. So a moment when we talk to managements that have big customer focus, they still think of the human touch. They still seem to be slightly naive about what might be coming, but then that doesn't mean they won't react if a competitor doesn't do something. So we really have to have our eyes peeled for what's going on in the space. We now have a small sort of VC operation within the group that we're connected to that gives us some line of sight of what's going on. And by working with our businesses and some of our partners, we get a look at how that's affecting things. So the puzzle is, as ever, tricky, but humans don't change very much. And a lot of our investments are really grounded in understanding human behavior, propensity to travel, propensity, we're very much in sort of Maslow's territory. What makes someone want a home, and how do they do that? And we can watch it in action, and things don't change very much. How do people consume? Those things that don't change very much, but change is the thing that's hard because our models have got to forecast the future. And if change is too rapid, then then we need to pay P's of 1s and 2s for stuff if we can't see far enough ahead. So, yeah, at the moment, it does feel like there's sort of a blizzard of change coming, but that's probably how it was when we started in 1998 with TMT, and people saying the internet's going to change everything. And you could buy food and beverage businesses for nothing because they weren't the internet. But it turns out people do still want to eat and drink, no matter how good technology is. So I think there's always a way through by sticking to the things that you know, and then things that you can observe in practice, and then being willing to react when you know you've got it wrong. I'm as bullish today as ever about whether we can navigate alpha through this. So nothing's changed on that. No.
Brilliant, Gary. Thank you. We've hit the hour point, so I think we'll finish the call here. But again, thank you so much for your time and your thoughts, and thank you to everyone who's attended today. There will be a recording which we'll send round, but looking forward to the next time. But Gary, thank you again. If there are any other questions, please email ir@frostro.com, and look forward to talking to you again soon. Thanks very much, Gary.
Thank you. Thanks, Urban.